So before to move to that one, I don't know if there are any questions from it. Yeah.
A couple things on the last two speakers. I've extensively studied Warren Buffett. What he is basically a put seller who levers 1.6 and does well in his investments. Now, one of his good investments recently was to sell some 18-year puts on the S&P 500. He collected $4.7 billion for this. And he did this well before there was trouble, and they reached a level of about 12 billion if you did a calculation. However, he was able to, by having 15 and 18-year horizons, to lengthen the trouble and smooth it out. So therefore, he could wait. They could not call him to get it at the bad time. He could wait it out because he always has a lot of capital. He's very, very good at huge capital because every position has a big advantage and huge amount of capital. So I think that's a strategy with the insurance to sort of smooth it out over time. Now, for my dear friend on the corner, I think that there's a big difference between insurance and the financial markets you're talking about. I believe you can predict a lot of the stock market things. Sebastian, Leo, and I have a 2012 paper where we predict the 2007 S&P 500 on June 14th, 2007, when the S&P was 1,500, 66 to 666 in March of 2009. So I think in the case of the stock market, we can have prediction models, like we have it in my book if you came to my talk, and also we can also deal with it very well with derivatives. We can do corrective action, quick do it, and so forth. The insurance company is more difficult because they have a lot of harder trouble if there's a big earthquake. One of my dear friends is Howard Conrath, who was a big predictor of earthquakes and something. I think they have a harder time. Now, if you have strategies that will lengthen it, like Buffett's, the nice thing about Buffett's $4.7 billion, he took the money and he loaned it to GE and Goldman Sachs at 10%. So he has a huge amount of gain there, and then he doesn't have to pay for 18 years because he's got European options, so forth. So I think there's a huge difference between the insurance way, which is basically put selling. I do a lot of put selling myself, so I understand the dangers of it. And if you do hedging, you're okay, et cetera. But I think in the stock market, in the financial thing, we have a much better chance to predict in advance what's going to happen. Except right now, like, for example, Trump. For example, I've studied extensively Trump, and I have my, if you went to my talk, there's two Trumps. There's the one who consults people, and then there's the one who's very calm. And he's alternating all the time, and that's why, exactly why I think you've got your graph that's bouncing way up. He's dangerous, because when the Trump number one is speaking and tweeting, there's a huge danger. When Trump number two speaks, it's very calm, and the stock market's rally. So I think there's a distinction between insurance that you need to sort of push it off into the future, and the stock market, I think you can deal with it faster, is what I do.
Thank you very much, Professor. And maybe Mauro, can you answer quickly, and also Professor Caronia?
Just a comment. I fully agree with you, Professor Zimba. And just an additional comment, I agree with you, the distinction between insurance and financial institution. I think that one thing is common for both. I agree with you about the possibility to do prediction. What is now different, in my opinion, is the ramification of this prediction. I mean, under the current background, with a huge asset management industry that sits everybody on the same part of the trades, with the development OTF and so on, in my opinion, what can happen following the prediction of a stock market correction could be very different from what happened in the past, and could be a lot worse than in the past.
Just one small comment. Yes, it's more difficult for insurance, but they have coped relatively well with those things. In 2005, the reinsurance industry had to pay, just for Katrina, Rita, and Vilma, $50 billion claims, while the whole premium of the reinsurance market is 160 billion at the time. So a third of it for one risk in one region, and there was, out of 125 companies, just one bankruptcy. So, and one of the reasons, I think, is because we are used to crisis. It's part of our business, and we are prepared to it. And what I think banks, even if they can predict or whatever, they need to prepare to those risks.
Yeah, thank you very much. Is any other question? Yes. Elena?
So I would like to go back to two things that have been said by Giuseppe Lusignani and Mauro Maccarinelli. So one is the effect of the cost of equity relative to the IRE. And the other one is the fact that we have low interest rate and whether this leads to bubbles. The two things are a bit related because, of course, the cost of equity, first of all, why do you think the cost of equity is so high? But this low profitability have been so. On the other hand, there is not yet evidence that low interest rates lead to bubbles. At least the ESRB conducted a very long task force on the issue of whether low rates lead to a problem of financial stability, and there was no conclusion, for example, that at the moment at least. So now the question is, of course, we could increase interest rates. So my question is then, do you think that's the solution? Because one important thing to consider is where the low interest rate come from. Whether these are just due to monetary policy, accommodating cyclical factor, or whether they're more linked to structural factors, so low growth, low productivity, and so on. So in that sense, even if we increase nominal rates with monetary policy, that wouldn't be the solution for increasing again the ROE. So how do you think we could deal with that then?
Elena, this is a $1 billion question and answer. It's very difficult to explain and to understand why, cost of equity is still so high, especially if you look at specific individual banks that they have so different, let's say, asset quality position and also profitability position. But, you can still see, differences, but slight differences. So my answer is, when we look at this model and we go this research through countries, there's of course some systematic factors or risk factors that, are in the banking sector. For example, in Italy, the high cost of capital, I think, in my opinion, still with the high level of risk of the country, the BTP spread, the low productivity, the low, let's say, long-term expectation on GDP and so on and so forth. And we can see differences among countries, but they're still high with respect to the movement that they've done during the recent year. The second factor is that there's an high risk premium, in my opinion, that is asked by investors for, let's say, this asset quality problem. In this situation, for example, I have an idea that NPL problems that is in the banking sector, the Italian banking sector, is overestimated in terms of effect, in terms of, let's say, in fact, we've done some research and we, let's say, made a sort of an exercise, starting from the investor point of view. And so starting from the IRR that the, let's say, specialized fund is asking, and then adding some servicing costs and other components, and then going back and go to see which kind of price this NPL has to be or should be buy, or let's say both. And then you find that very huge differences between, the price that is asked by the bid price from these specialized funds and what the model and also the banks are available to sell. So this component is something that is moving to this risk premium that is embedded in the cost of equity. And then there's a low profitability perspective. Of course, the banking sector in some countries and the Italian banking sector has a very, very low level of future, let's say, expected return of equity. And there's a high level of life cost income level, very difficulties in changing the business model. So all these components, I'm not able to say exactly which one is the main, but all these components are keeping very high this return of equity. And also in the specific individual banking position. We don't see in the markets this lower level of, or let's say the low level of risk premium that in some way could be expected to be. So that's my answer.
Yeah, I think we have time for another two questions. One question, yeah. And just can you use the microphone, sorry, because and quick because we have really 5 minutes.
No, I'll be
to close, to wrap
very
up.
short. Expect the trouble in August, September. Now, the historical studies, if you go back many, many years, are that the period from May 1 to the turn of the month of November essentially have like zero returns. Now, the last 6 Mays have been positive for the stock market, the U.S. stock market. So, and my studies are, if you go to the futures market, for small caps and large caps in the United States, you get 2.5 times the return if you went to cash on May 1 and then got out later for small stocks and 2 times for the S&P. So expect the trouble to show up in August, September, October. That's when most likely you're going to have the trouble this year. And I don't know if it's going to come from Trump or somebody else, but more than likely that's when the trouble is going to show up.
Thank you very much. So I think it's, maybe I would like to wrap up a second, maybe for Francesca and Aldo, because I think also for what Professor Zimba said, I'm interested to have in a nutshell, in a soundbite, your view of where you're seeing the potential kind of risk that could have an impact, because you design, you give a fantastic picture where we are in terms of regulation and be sure that we are in a safer system. What do you believe is where is the next challenge coming from? I will start with Francesca and then Aldo, then we wrap up. Thanks.
Let me be very brief and react to this by saying that the main risks or the most important risks are probably the ones that we cannot predict at all. So this is again back to my point before. It's unfortunately the fact that we cannot expect to predict anything which will come after. So that's why we have to act on some underlying characteristics of the system and diversify as much as possible. This is exactly my point.
Well, just one sentence, nothing more. We are late, but I mean, well, for banks, as I said, we are almost reached the end of a regulatory reform. We spoke today of fintech before, the digital revolution. I think we should be aware of that. I mean, that is where probably the risk in financial system stays.
Thank you very much. I'd like to thank all the contributors.